Hello and welcome to another platform tutorial. This is Thinkorswim and we're focusing on order entry. With exit brackets. And so this is what I refer to as an all-inclusive order. It's going to include the entry plus exits so we can walk away and not have to worry about hovering over the computer screen in order to get in and out of our positions. Now I'm using this as an example. This is Twilio, ticker symbol TWLO. And what you can see is Twilio has most recently rallied right up into an area where we have what I refer to as a confirmation entry short position in. We have negative divergence. This is all, looking pretty bearish. And so Twilio here, just hit our confirmation entry area and started to drop away. So it hasn't gotten away from us. So if you want to know more about how it is that we trade like this and what does it mean for a confirmation entry, go check out some of the other videos we have at TradersArmy.com. But ultimately, this is just focusing on order entry so you can understand what it looks like to place your orders using the Thinkorswim platform. And I got some pretty advanced, really cool techniques that I want to share with you as well along the way. But again, more information, head to TradersArmy.com. Unless you're already there, then continue watching some more free videos after this. But this is going to be a video focusing on what's known as a bearish call spread. So I've got other tutorials for other types of option trades. This is specific to a credit spread, and it's specific to a bearish credit spread. So this involves, I go ahead over to the Analyze tab, where I've already set the trade up, selling a $290 strike call and buying a $295 call above it. And so basically what we're anticipating with this bearish call spread is that Twilio stays below 290 over the next 3 calendar days. So this is just a 3-day trade that we're talking about. So 290 to 295 is going to be our spread width, so $5 wide. Right now, this position is quoting 93 cents credit per share or $93 per contract. And so I've already done the risk reward analysis on this. Again, if you want more on how we do this, TradersArmy.com. So 290.10 is actually going to be where my protective stop is. Now, a lot of times folks are not going to use protective stops on their option positions because a lot of times options are, looked at as they already carry defined risk. So if I have a $5 spread here and I'm getting 93 cents credit for this, the most that I could lose if I'm wrong is the other $407, which is $500 spread minus $93 credit. The other $407 is risk. Now, I don't know about you, but I'm not interested at all in risking 4 times what I stand to make. And so there is a point in which each trade, and this is for every single trade you have, there is a point where you're always going to be proven wrong if the market moves against you by a certain amount. And so the way that I look at this is if the price is above 288.84, we're in all-time highs. If the prices go above 290, I was wrong because in this trade, I'm expecting prices to stay below 290. That's why I'm selling this call option. Again, not a lesson on bear call spreads, but I'm just giving you context on this trade here. So if I'm ready to place this trade, what I can do is I can go ahead and right-click anywhere on this simulated trade after I've done my risk-reward analysis, where I'm basically risking $110 above 290. So if the stock goes above 290, I want to close this position, and I'm anticipating losing about 110 bucks. And so I'm okay with that. I'm okay risking 110 to make 90 something. Because the odds of this stock actually staying below 290 are very high, considering we've got our fair price value supply area above. We hit it. We started backing away. The price of Twilio doesn't have to go anywhere for us to make money. It could drop, which is what we expect. And even if it rises a little bit, that's okay, as long as it's not above 290. But if it is above 290, our protective stop that we're about to place is going to kick us out. So what I do is I right-click anywhere on this simulated trade and I create a duplicate order. Now, down here, Thinkorswim gives you the option to change, and you're going to need to change this for this more advanced order technique that I'm about to show you. Now, you could just go ahead and confirm and send it, and you could try to get filled on this entry order, but then you would have no stops or targets or anything in place. So you'd be kind of just out there willing to risk it all to make 93 cents. And so which I wouldn't say is wrong. It's just, it's not good risk management necessarily, in my opinion, to risk 4 times what you stand to make in this trade. So in order to have this set up in more of an advanced way like I'm about to show you, we have to change this advanced order type to what is known as a first triggers OCO. So OCO stands for order cancels order. And so from here, this will actually allow you to set up some exit orders behind your primary entry order. And to do that, the easiest way that I found to do that is to right click on the entry order and then simply hit create opposite. And you're going to want to do that twice for this particular trade. One of these exit orders, and you can see they're both green, so they're buying back our short option position and selling our long option position, but it's all part of the vertical spread, right? So I want the exit orders first and foremost to be good till canceled. I want these orders waiting and waiting and waiting and working so long as the position is open. So I go ahead and change those to good till canceled now. If you want to, enter the, good till canceled on the entry, you could do that too, but I personally like to leave it good for the day. And if I don't get filled that day, then I'll come back the next day and see why did I not get filled? Do I still want this trade? And if I do, I'll simply reset it back up. It takes just a couple of minutes. So first things first, I like to, if I can, take profits earlier. The earlier, the better, right? In my mind, if you could take profit or take some money off the table early, then I'm all about that versus waiting until expiration for these options. Now, these options do expire in 3 days, but what if we could buy this option spread back for, say, 10 cents or better, right? What happens if we could buy this option spread back for 10 cents or better? Well, that means that if we were able to sell it for 93 to open this position, and then between now and the next 3 days, buy this spread back for 10 cents, that means we get to keep the other 83 cents per share, so $83 per contract, which is, $83 per contract on a $5 wide spread would be, doing a quick little math here, it would be around 16% return on investment for 3 days. So if you could close the trade out early, I'm all about it. If we don't close the trade out, it'll simply wait until expiration. And if the options are still out of the money, we'll make the whole 93 cents. But I like to buy back for a cheaper amount to where I'm actually buying back for a majority of my profit potential to remove the risk, the buying power requirements, and just bail on the trade early versus waiting around for the last 10 cents when you've already made 83. So you can put whatever number you want in here. I know some people, some of my students, they like to buy the option spread back if they've made 80% of their profit potential. So they would end up buying this back for around 20 cents, keeping 73 of their potential 93. I know people who put this in for 5 cents, right? I just kind of look at this and say 80% or 10 cents, something like that. That's a good little number to go ahead and buy back these options if we can. And that's just saying, I'm going to buy this option back for 10 cents if I can. If not, then we'll move on to the second order, which is going to be our protective stop. So now this is where we can get fancy, right? So I'm going to come all the way over here to the cog on the right. I use this cog a lot because it's where we can actually set up some specific order rules, okay? And so this little section here is actually broken up into 3 sections, right? So the above section is the order itself to buy the vertical spread back. The middle section is under what condition do you want to buy the spread back? And then down below is a plain English description on what you're trying to set up so you can read it in plain English. So first and foremost, under what condition do I want to buy back this spread? Well, when I'm proven wrong. That's it. When I'm proven wrong, I want out of this position. And so if I go under symbol, method, trigger, and threshold, and I start with symbol and I just click underneath, it drops in Twilio because that's what we're working with. That's the stock we're working on. Mark price is ever greater than or equal to. So I want to see if the stock goes above 290 plus 10 cents. So if it goes above my short strike by 10 cents, then I want out of this position. Now, if you want to keep it simple, then I would suggest using a market order to get out. So if the price is above 290.10, it's just going to simply close this trade out at the market price. Now, you'll see that the spread between the mid price and the natural market price is very wide. So a little word of caution here. Anytime you use a market order to get in or out of a position, you're always going to get filled at the natural either ask or the bid, right? You're always going to get filled at the worst possible price if you use a market order. But the good news is if you get filled on the market order, yes, it's the worst possible price, but at least you're out, right? And so if you use any other type of order, then you wouldn't necessarily be guaranteed to get out. But this lets you get out so you can't lose any more and you're done with the trade. It's simple, it's straightforward. I recommend this for anybody who's just getting started in options or who doesn't want to really kind of get fancy or cute with your order entry. But I like to take it one step further, and I'm going to show you now how I like to set up my orders to negotiate my way out, okay? So I'm going to change this back to a limit order, and I'm going to link this limit to the mark price of the spread. So you might have seen this in some of my other option tutorials that I have at TradersArmy.com for order entry. But if you haven't, go check those out. We have a whole list of order entry and platform tutorials, order entry tutorials, all inclusive, stops, entries, targets, you name it. But you might have seen this, but this is a really neat trick that actually says, if the price goes above 290.10, I don't know exactly what the limit price is going to need to be for me to buy this spread back. I have no idea how much this option spread is going to cost me. I can guesstimate and I can estimate looking at the option risk profile. I can anticipate what it's going to be worth, but I don't know what it's going to be worth. Time decay, volatility, your option Greeks, they're all going to affect the price of this option. So what Thinkorswim lets us do is change this to the mark price. And the minute I do that, if this condition is ever met and the stock is above 290.10, the platform now is going to look at this spread, the 290 by 295 bear call spread. It's going to look at the mid price and it's going to grab the mid price at that moment. It's going to tell us what the mid price is. In fact, it's going to submit a limit order to actually buy this option spread back at the mid price directly in the middle. Now, the odds of you getting filled at the middle, at the mid price between the bid and the ask, the odds of you getting filled, they're good, but they're not great, okay? So what I like to do is when I'm negotiating my way in or out of a position, I always like to give a little bit more to the market and say, okay, I'm willing to buy this spread. And I look over here and I can see that the difference between, you know, the mid price and the natural price is about 50 cents. I know that I'm not going to have to pay the natural price, but I also don't want to think that I'm going to only have to pay the mid price. I know that it's a good probability that I could get filled at the mid, but it's not great. So in order to have a great probability of getting filled, then I'm going to have to be willing to pay above the mid price. And I always look at how wide is the mid to the natural. And in this case, it's around 50 cents. So I'm just going to go ahead and split that difference in half. And what I'm going to do is I'm going to say I'm willing to offset by paying 25 cents more than the mid price just to get out of this position, okay? Now, it still doesn't guarantee that you're going to get filled because you're using a limit order, but because we are willing to pay 25 cents now above the mid price, then this makes it more probable that we can go ahead and get filled. Now, the market is closed right now, so these spreads may be a little abnormally wide, but you're always going to want to look at whatever option position you're trading on whatever stock you're trading, and just look at how wide the market normally is between the mid and the natural. Split that in half and then offset. And because we're buying this position back to close our bear call spread, I'm going to add 25 cents to this, meaning I'm willing to pay 25 cents more than the mid price to get out. And again, that's going to improve the probability of you getting out of this trade without actually having to choose a market order and get ripped off at the market price. So we've got our condition in, we've got the order above, the order that we want to place, we hit save, and then what we can do is confirm and send this, and we can take a look and read it carefully. Always read your confirmation box here. So the first thing we're looking to do is sell the September 11th, which is, actually this is not 3 days. This is, hang on. Yeah, I was looking at the 3 days. This is the 10-day option. 10-day option on this one, okay? So on the 10-day option, let's go back to the order entry here. We confirm and send. This is a 10-day option. My mistake on that. And so it's a September 11th expiration, 2020. It's 290 by 295 bear call spread. If we can get 93 cents for it, it'll open the position when the market's open. If that order is not filled, then it's going to cancel everything, okay, by the end of the day, because it's only good for the day. If it's filled today, or whatever trading day you happen to be on, then it'll automatically send the next orders, which are going to act as a bracket order. Order cancels order. So whichever one of these two closing orders fills first, it'll cancel the other order, and then the trade is over. So ideally, we get filled on this first one, which is buying back the spread for a measly 10 cents, which means you get to keep 83 of your potential 93 cents per share. Now, if that one doesn't fill, we'll just stay in the trade. But if this one fills, this means we're going to get out also. So we're going to buy back this spread for 25 cents above the mid price, which is what MARK stands for, but only if Twilio is at or above 290.10. So if the market goes above 290.10, it's going to trigger the buy order to close the position for a bit of a loss. Once the position is filled and it cancels the other exit order, the trade is done and everything is over. So I can go ahead and send that. You can see here how this is going to affect your buying power. So it's going to reduce our buying power by $408. You can see what your commissions are to open this trade. You can see everything about this trade right here in this window. So if you like it, after reading it carefully, hit send. And now you can come over here to your monitor tab and you can see that these are all linked together by this key order, which is the entry order, followed up by the brackets, which is an OCO, order cancels order. So if this doesn't fill by the day, and this will be working all day tomorrow because the market's closed right this moment, and so if it doesn't fill by tomorrow afternoon, it'll simply cancel and everything goes away. If you still like it the next day, then just go ahead and place it again. It just takes a few minutes to get it all set up and ready to go. So if you have any questions about this or anything else, please hit us up, support@tradersarmy.com. If you want to check out some more free trading videos, or if you want to check out some more order entry videos on different type of option positions, different types of spread trades, some more advanced, some simpler option trades, head over to TradersArmy.com. Free trading videos, platform tutorials, all you need to get you up and running on the Thinkorswim trading platform. Like I said, if you have any questions, reach out to us. Hope you enjoyed this, and until next time, be safe. We'll talk to you soon. Bye-bye.